money makes people emotional. Do I put it into my super or
Yes.
am I paying off my mortgage?
When it comes down to that question of should I do this or should I do this, the answer is yes.
Hello and welcome to Super Insider, a podcast proudly brought to you by Australian Retirement Trust on all things super, funnily enough, retirement, investing and the economy. Now today, 15 minutes of your time, we'll answer the question, should you pay off your mortgage faster or boost your super? With me to discuss this higher order question is Brad Monk, or Bradley Monk when he's in trouble, from LifePath Financial Planning. And we've known each other a very long time. It's so good to have you on or in the studio on the couch.
Thank you, Anne. I'm really excited about this one.
Yeah,
it's going
good
to be
one.
great.
It will. But before we do that, listeners and viewers, general advice, general information only, and do not act on anything Brad and I are talking about today without getting some professional advice. And we would strongly encourage you to speak to a financial advisor, give us a call, jump online, do something, but do not DIY, please. Okay, so your expertise is just talking to just everyday mum and dad Australians. You know, it's a very generic term, but that's what it is,
Yes.
about the simple, higher order, big questions people have about money and maximising retirement and paying off debt.
Yes.
So maybe let's start with the principles around the mortgage, the impact it has on someone's finances and what superannuation does conversely.
Where the media comes into play is all about mortgage rates, how expensive it is now, is it affordable? So you've been bombarded by this unaffordable mortgage. So that's a massive burden. And then the complexity of superannuation, I don't really understand it. Should I be putting money into it? What is it? Is it hocus pocus? Is it magic
Is the government
pudding?
going to meddle with it again?
That's right. So you're conflicted on what you're going to do. So when it comes down to that question of should I do this or should I do this? The answer is yes.
Yes.
The answer is yes. You should do something. And sometimes when it gets so complex, they don't do anything.
Which is just the worst.
It is, because it's so easy
Inertia.
to do nothing. You go, "Oh, I should do that. I should do that." Having a plan, having a strategy. And it really depends on where you are in your life and what you want to do with that and the amount of money that you've got as well.
And let's just go basic one-on-one around a standard mortgage, a variable mortgage, and the interest you pay on that. If you had a $500,000 mortgage, and like not getting into a case study because we are going to do a case
Yes.
study, but versus what a traditional super fund might earn, like us.
Yeah, well, that's true. So, look, I've been very blessed. While I'm grey, I never
are.
had the interest rates.
In fact, I just die, man. It's so good.
I never had the interest rates of my parents, which are the high 18%. So interest rates are quite low and historically low, but the mortgages are high. And I think there's the problem there. They'll talk about low housing prices, but now mortgages are a lot higher. And I think returns on super funds, while those interest rates are lower, returns on super are lower because of our fixed interest are generally giving us a lower return. So our more conservative assets, whereas previously with the really high interest rates, then you would have high cash returns as well as high shares. So I guess they're both even now. So mortgage rates are a bit lower. Returns are still high, but not as high as what they used to be. But we don't need that because inflation's under control, except at the moment, but they will get that back under control. So you've got to work out rates versus return, and that's your situation where you are. So do I want to keep my rates low, my mortgage rates low, or do I want to get a higher return on my super and put money into that?
And again, to your point around different stages in life, because if you're a younger person, you can be invested in a more aggressive or, a more aggressive option with higher weightings to shares, and therefore, the returns are much higher than term deposits. But if you're closer to retirement, then
100%.
you're probably not going to do that.
Yeah, and that's where I guess you need to understand what your risk tolerance is. If you're somebody who loves to watch your super balance daily, then just be very careful because you'll have an ulcer.
Yeah, to get some help. Yeah.
But if you're young and you think super's down the track, volatility is great. Like, people find volatility is a negative, but for young people, if you're getting a little bit of a downturn, your money's going in each week, you're actually buying more. So I actually like a bit of volatility for young people. So a high risk profile is generally good.
And that reminder, actually, because we're probably about the same age, and I do remember houses for sale in Augenflower, which is a suburb in a Brisbane, being in like $30,000. But you're right, this is in the late 80s, but the interest rates were significantly higher than they are now. So to take this up a level, superannuation's been around for 33 years,
Well,
1992.
No, well,
34 years.
Yeah.
34 years. And we've also got the first generation of baby boomers departing the earth. And there's a big transfer of wealth
Massive.
to Gen Xers like us, who are the first generation to have superannuation for the full working life.
Yeah.
Okay, let's imagine you are a 52-year-old and you have a very benevolent auntie who passes away called Anne-Marie. Anne-Marie's leaving me $10,000.
Right.
But I have a $700,000 mortgage. And I come to you and I say, Brad, what do I do?
Wow, that's a great question. Now, there is no right answer.
Yeah. Do I put it into my super or
Yes.
am I paying off my mortgage?
Yes.
10 grand's not that much. What's it going to do?
And I guess you need to know what's your role. So do I have a really good salary, so I've got surplus cash flow? Am I in a salary that's so high I cannot put any extra super contributions in and claim a tax
So
deduction
you've
for
capped
it?
out and that number would be
$30,000.
$30,000.
$30,000. So you go, all right, well, I cannot put any more money in. So how do we look at that? Do I have a partner that's not working or their salary is less than $40,000? I can put money in as a spouse contribution. So that's a maximum of $3,000 and you get a tax offset of $540 straight away. So it's 18% return. It's a bit nerdy saying it that way, but
Well, that's solid.
yeah, it's really good straight away. That's money that you're not paying the tax office. Or you go, well, look, do I want to do both? Do I want to put a contribution to super, claim a tax deduction for it, and put some money into my mortgage that if I did need it, I could redraw back from it? And I guess that's what I'm worried about with mortgages. If you put money into a mortgage, during the 90s, they brought that line of credit in. Do you remember there was one
Tell me
particular...
about this, the 90s. What was that?
Well, they invented this little mortgage thing called the line of credit where you could put
yes.
money in and then you could take it out. And the
Yes.
banks would say, where'd you get that boat from? And they go, oh, equity, mate. So with the property prices
Yes.
going up, they're now redrawing. So I think super's great forced savings. You put the money in, you cannot get access to it until you reach preservation age.
But
or
it really
rules.
is so circumstantial. And in all seriousness, I do have an auntie called Anne-Marie, but I have not had a windfall of $10,000. However, I have 3 children, one of which has finished school and one's about to finish school. And certainly that is a windfall of cash when you're not paying school fees. My husband didn't work for like 10 years because he was the stay-at-home dad raising the kids. That was the same kind of trade-off question we had is like, do you put money into Frank's super because his balance is so low compared to mine because he was the stay-at-home dad?
Yep.
Or do you pay off the mortgage? And I mean, just in the Fuchs family, we're topping up Frank's balance.
There you go. That's brilliant. Well, see, look, I worked with a guy, back in the early 2000s, and he was really big on the rule of 72. So
The rule of 72.
So compounding. So if I can get a 10% return, every 7.2 years, it will double. Or if I get a 7.2% rate of return, it will take 10 years and it will double. So if I was 52 and I was looking at my super balance, knowing that I've got my mortgage under control, but I really want to top up that mortgage for a good lifestyle in retirement, bang it into your superannuation. Especially now, look, there's a bit of a discount rate at the moment due to the market volatility, but it could be peaking.
And it's the tax benefits too of superannuation because you're paying less tax and then that compounds and the money's working really well for you. But when you say you've got your mortgage under control, I think there's very few Australians that would actually feel that way. What does that mean?
Well,
that
it's
statement?
your stage of life. So if your first 10 years, your mortgage generally isn't in control. So I'm going to just say some numbers. So if I'm 25 to 30, get my first mortgage, suddenly I'm having a family, like it's out of control. You're accumulating debt.
Is it a percentage of your income? Is it like when you say in control? What does that mean?
Well, I
Sorry,
think if you've got a repayment, repayment on your mortgage and you say, well, look, if I've got this repayment and I will have this house paid off in 25 years and I'm comfortable with that, then it's under control. If I'm struggling week by week to pay my mortgage, maybe go for a fixed rate so I've got that cash flow, and then maybe even a bit of salary sacrifice. I know we're talking a bit differently, but you should still be topping up your super because that compounding benefit. I just don't think you need to race out and pay off that mortgage in the first 5 years. So for me, I'm a big believer of life. And if you stop life just to pay off a mortgage, you're missing out on a great period
Totally.
of
And
life.
the concept of retirement as an end date isn't necessarily true anymore. People go back and forth, they slow down.
Yeah.
How does that play into the conversations you're having with your clients in terms of decision making? Are they more comfortable slowing down, having a bit of debt in their mortgage still?
Yeah,
Yes?
absolutely. So the baby boomers were the generation of work, save, and then when I'm 65, I'll go overseas
And I'll have no debt.
and I'll have no debt. Whereas Generation X then comes in and says, well, look, I'll do a bit more travel. And then the future generation now, like my young children are...
How old are your crew?
I've got a 22, 21, 20 and 18. So they're doing travel now. They're doing a bit of travel overseas, which we probably wouldn't have done at the start, maybe. But so they're living life. And I think they'll happily work longer. So they might not work full time. So they might work 3 days a week when they're 65 to 70 because they've enjoyed their life along the way. I think what you cannot do is go really hard on your mortgage, be really frugal, and then think you can spend it at the end because your habits won't change.
No, but hey, you've trained your brain. It's a long-term trend that we have seen, Brad, of members, particularly older members who lived and their parents were of the Depression era and they're departing this earth with too much of their balance intact because they're just terrified. They're just so used to being utterly frugal to their own detriment.
And I think now it's like we get our older clients who have got their mortgage under control or paid it off. They're looking forward to a fun retirement, but now fearful of aged care. So there's always something to be fearful.
Yeah, well, that's true, isn't it?
There's always something to be frightful, scared of. So we sit down with people and go, well, look, spend now, enjoy this bit. You always got to have a plan, and parents are so generous. Parents always love to keep money for their kids. I don't know why. I've got 4 and I've told them I'm going to spend it all. But we are a very kind society. So we like to look after our children.
And just to be definitive, is there any situation where you would say, yes, put it on the mortgage? Is it an amount of money? Is there some kind of thing where it flips?
Life stage. So people talk about age. I think superannuation only has an age issue when you are getting close to 60. So if I'm putting money in at 50 or below, understand you cannot get access to it. It's locked up until you're 60 and you meet a preservation rule, or you're 65 and then you can get access to it. So you've got to be very confident that you don't need that money. So if I was in my 30s, I would be probably not likely to throw money into my super other than salary sacrifice. You must be salary sacrifice, and it's money that you won't miss. You just got to try and figure out what percentage you should do. I think that's a really good way of compounding there. But yeah, 10,000 windfall, generally the early stages, bathrooms get done on their houses, mortgages get paid down.
So the closer you are to retirement, that's when it
I would
flips.
think so. Yeah, I would definitely think so. And we have that FOMO, that fear of missing out, especially when the market's peaking. Everyone goes, I should be in the market, or suddenly should I be investing into silver or some commodity? And that's my greatest fear is when they come talk to me and say, should I be investing into this new
gold? That's a question we get all the time.
Yeah. Should I be doing that? Well, maybe you just put it into your superannuation or put it into your mortgage where you actually confident the return will be there. So the bank wants that interest rate on their mortgage, and you can go, well, look at ART, the 10-year average return. You can look at that and say, well, that's historically sound, so you can put your money into that as well. I don't speculate. That's just me. I'm not a speculator.
No, good. Okay. Well, I think what I've heard from you is that, and we did say this, it's to listeners and viewers staring at you down the camera, is that it isn't a hard and fast answer, though we do know that most of our listeners and viewers are tending towards the retirement side of life as opposed to 20-year-olds and 30-year-olds. But if 20 and 30-year-olds are listening, then yay you. Yay you.
Yeah.
But it really depends on your debt, on your health, on whether you're partnered up or not.
Yeah.
Your balance.
That's right. The right decision sometimes isn't the best financial decision. So what's right for you might be, I need to pay off the debt because of the emotional risk that I have with it. Or, no, I really need to top up my super. So sometimes you've got to find what's right for you, and that's generally getting some advice, knowing where your situation is, where do you want to go, and get that advice, and then someone will be able to guide you to the right decision.
27 years I've been in the advice sector, superannuation sector, and high conviction say that financial advisors help. Money makes people emotional. And to your point, the right answer may not be the most mathematically the highest number, but it's the one that allows you to sleep well at night and be happy.
Yep.
And also gives you permission to do the thing that you want to do and you didn't know whether you could do.
Yes. And I have a financial planner. Because I do get emotional, and because I read so much, suddenly I'm thinking maybe I should do, that DIY.
Yeah.
Then I'm like, maybe I should do something myself. No, I don't. I actually have a financial planner who has the strategy for me, and we work it out together, and I just don't meddle with it because I know I want to.
Okay, well, listeners and viewers, we hope that you learnt a lot and it's given you something to think about in the event that you are tossing up whether you pay off your mortgage or boost your super. We look forward to you joining us again soon. Make sure you hit subscribe and share this with anybody in your life that is asking this question. We'll see you again very soon.